advisor. A registered investment advisory firm started with his daughter Isabella, who's the lady there doing everything in the slide. And Randy also operates personal and professional tax services with his wife Kathleen. Previously, Randy was a financial advisor in Ameriprise Financial, H&R Block Financial, and Charles Schwab and Company. And he also managed 2 community banks in the San Francisco Bay Area for over 10 years. And then combined all together, he holds about over 40 years of experience in investment, banking, taxation, and mortgages. In the community, Randy has appeared regularly as a guest speaker on financial talk shows in local Chinese radio and TV stations. He also volunteered with the CCC, which is a well-known organization in Chinatown. And this is where I came to know Randy after meeting him in some of the voluntary functions, and also listening to him talking over the radio as a guest speaker, probably the end of early March at single TV station. And with that, ladies and gentlemen, I'd like to introduce Randy Tam. Please welcome.
Good afternoon, everyone. How are you doing? Good. Okay. So nice. If you can hear, good. If you cannot, raise your hand. Okay. All right. It's serious, but I don't think it's very serious at all. The reason for that is really this about tax information. I know it's not your favorite subject, right? Everybody needs to pay some tax. The question is, if you aim to pay tax, making good money and so I'm actually not very good.
你到哪里去听？
我到那边去。
你到那边去听了，要不然就声音就算了。
就听。这个有没有好一点？
没有声音，没有声音。
But some of the advantages you may not be able to take at all because you haven't paid for 2023. So what we're going to do today is offer plan something for 2024. In case you miss something, you will miss it again. All right. So with that objective in mind, also let me see. If you have some question, I would like you to save the last when we have a Q&A session. Thing for the Zoom. Maybe they may have to type in or chat in. So it's here to catch all those questions and ask, so we can answer those appropriately. All right. Okay. With no further ado, let's take a look at. I think Ben's already given the next information. So let's look at the deduction here. As you know, for the stamp deduction, most people need to have a mortgage, have some property they may available to item and deduct the all the items under the taxation. With the 2017, the tax law change, Trump tax is sunset in 8 years. So between we go all your items again and see we can fit all the stamp deduction. Most people doesn't have a mortgage, probably they're taking stamp deduction. Either they are single or they're married by joint. So if anyone remember they still able to take itemized deduction lately? And so on. Okay, so for some of the reason, maybe that's a medical bill that you have a large one occur in the year over 7.5%. So you can move back to itemization. But The state tax is limited to $10,000 only, including all the property taxes you pay, portion of the DMV that you pay, some of the state taxes withheld from your retirement pension, if you're still working part-time, have fun with that. Those are withheld, but they are limited to 10,000. So the next item is the mortgage. If you don't have mortgages, you probably don't be in the picture. By every under the 15,000, 60,000, 30,000, or 32,000. So you're under that, it's better off to take a standard deduction and reduce your taxable amount. For some people who are making a large donation, that is also itemized. The strategy is you add up all those and try to donate it in one single year instead of doing a small amount out of multiple years. So we can able to maybe optimize that and doing it by patient for that particular year. So those details you probably want to discuss it with your tax preparer or maybe a CPA, so they can help you to strategize that a little bit in order to take advantage. Not every year you use the standard deduction only. Okay. All right, let's move on to the next one to look at. Where's the key reminder for 2023? As you know, if you are 73 this year, turning 72 in 2023, you are required to take a minimum distribution from all your retirement accounts, including IRAs, 401k. Now, here's the little special item bank in the federal. If you do it from the IRA, so you have multiple IRA accounts in different custodians, you can lump it together and take it from one only. However, if you have multiple 401k, IRS has a different rule for you. You have to take it from each 401k individually. So the maybe best is you roll over those 401k into one IRA, then you don't have to do that. So anyone have a multiple 401k somewhere when they in the lifetime, maybe 4 or 5 different employer before, you're still maintaining those 401k, maybe time to take a look again and make sure that you don't go into that trap that you forgot to take from each 401k. Any question on that? Okay, so that means, but if you see here, you got 2073 in 2024. April 1st, not April 15th, next year to do it, the minimum distribution. But besides the minimum, you always can take more, and just pay a little bit more tax, that's all. But if you do that, that means in 2025 tax year, between January to December, you need to take 2 RMD. Why you need to take 2 required minimum distribution? Because when you did not take it, you wait until 2025 to do it. That means 2025 also have another RMD for that year. It may bump you up to the next tax bracket, which is not a good idea. So if you require to take something out this year, do it this year. So you lessen your combined income, which is not going to move you over to the next tax bracket, so to speak. Because the tax bracket, the lowest one right now is 10. The next one is 12. However, the next one after that is 22. You jump quite a bit. Of course, you're not paying the entire thing for that rate. It's a progressively, whatever the amount over that, you pay with higher rate. But however, if you know, the Trump tax will be sunset in a few years. That means the tax rate might be called correctly. It doesn't have a 10, doesn't have a 12. The minimum is 15. The next one is 28. Ooh, okay, is it big up there? 10, 12, 22, 24, 35, and 37. Next one, if all that sunset in 2 years, the rate will be something 15, 28. I think the next one is 32, and then it's 39.6. Okay, it took 30 years to have that change 5, 6 years ago, and it's only good for 8 years. So that means a little bit planning for the next 2 years, very, very, very important for all of us on doing the itemization or taking a standard deduction. Okay, as you can see, also there's a few exceptions. So I'm going to read it so everyone can see them. And unless you have a question, we can talk with that. Talk about that later on. So let's move on to the next page. This is the social security. A lot of people have a big jump social security maybe 2 years ago, 8.7%. Of course, last year it's only 3.2. So we did not have much income increase this year. However, you also dramatic change part A also taken out from your social security check. So in the fact, you may see about what $50 at the most. It's the jump from your paycheck. So you didn't see much increase compared with a year ago when we have 8.7% jump on the social security. So that means the net amount not really affected because they go by inflation. They call it inflation normally the announcement for that is the end of the year, like November, December, they tell you what the next amount will be. Okay. So with that, we can look at the Medicare. Okay, so for the higher the income you are, you're going to pay a little bit more on your Part B. So as you know, your Part A is 3% coverage is 5%. The 20% is covered the Part B, and that is based on the income level, the taxable income level. The higher the income is, so we paying the 174, the highest would be $594, which is for people that will earn taxable amount over 500. For the married couple, that is $750,000. For those, most people probably paying something in between 244 or the 349. So that means the higher the income. So some people say, why do that? They have looked back 2 years. So if you have a high income like selling a home, have a big capital gain, it may impact to your Medicare Part B 2 years after they receive the tax return. You don't see it immediately until you file the tax return. Okay? That also comes with, most of you already have the advantage or somebody call it supplemental, that's called Part C. But some of the organizations, they don't provide the B. That means you have to go out and buy the Part B also. For example, people have Kaiser. I think Kaiser, they're already including the Part B, so you don't have to purchase it separately. But for the people who buy it for supplemental, similar to Part C, you may have to buy the additional cost for the Part B, just for the medicine, for your drug costs, okay? And I know some people that may not be able to take the generics, so the cost of the but our pocket. So those, if you have a amount our pocket, you may want to think all those receipts and see that you're able to itemize through your scheduling. So those payments, you need to keep track. And as long as they over 7.5% of your gross income, it may be able to move it to your Schedule A. Or you should keep track for those who are not preparing the tax return and help from your tax preparer or your CPA. So you may give them the correct information. So they'll be able to help you to get the most mileage out of your deduction. All right, so with all these changes, Security Q, the next one is something that just come up this year because with the pandemic, the Security 1, Security 2, finally, they try to update a lot of stuff that is in question. So what is the active? So let's take a look at the question. Individual under 59 can pay more penalty. Okay, usually they already have some, like you're really ill or whatever, you can take some of those to pay the medical bill. But the 10% additional penalty will be waived if there's an emergency. They're not picking up the document. Document is not too much, but at least you can pick it out and hire even though you're under 59 and without paying penalty. But you still have to pay the direct income tax because that $1,000 is included in your income. They can take up to $10,000 for the item that hopefully doesn't appeal to any of us. Okay. All right. So let's see what the next update. You decided to go. If you are 72, we already mentioned that, but don't wait. That's a key thing. Don't wait. You are 33 this year. Don't wait until 2025 to take the first one. Because if you do, 2025 you have to take two withdrawal, which will bump up your total income for the year. And definitely you may have to pay a high tax bracket tax on whatever the combined. Okay, so for these reference, anyone last year on after 1960, except Isabella. Okay, so that means you're already doing the RMB, and hopefully you will not get to take that if you're born before the age. All right, let's take a look at the next line and see what we have. They also update something else. For the survival file, they can also delay the RMB until the age of the deceased file. Used to be the deceased person after they die, the spouse, the surviving spouse had to start taking the RMB right away without waiting because they had matched the age. But now they can delay it until later. So that means you can by say, I don't have a big income, but the impact is, if you know the rules, you can take money out from your retirement account at what age? Anyone know that? Without any penalty, just pay the regular tax. 59 now? That sounds familiar? 59 now, that's correct. So 60 years old, you can start taking out money. So take a look at that. Required minimum is something that they force you, why you want 9% force you to take money out, why you can enjoy your money. So it depends. Between 60 and 73, that's 13 years there. For you to divide up the big chunk of money. Remember, things that roll really good for the last 10, 12 years on the market. That means your $1 million probably maybe double or maybe a little over in that 10 years. So that means you may be forced to take more money out at 73. Remember I talked about the bracket earlier? If you take some money out and stay in the same tax bracket to even out the impact of paying high tax when you come 13 years later, until I want to take, I think right now the table popular. So that means you can take that used to be that's a 4% rule. I think now 3.89, something like that. So I still rock it up to 4%. If you have a portfolio like it's 2 million, 4% of that what? It's $80,000 added to your other income. Maybe getting social security, you may still have a rental property, you may have some tax, insurance, dividend. When you add all that up, so for sake of discussion, let's say you have $50,000. Suddenly you need to add another $80,000. Don't you think you will move up to the next tax bracket and you can pay for that? So the idea is, in that case, for that 14 years, you can even it out a little bit, maybe $20,000, $30,000, and won't move yourself in the high tax bracket in the future. But people say, take the money from the IRA retirement account for 1 year, I could use it. Well, you can start using it, plan more trips or whatever. Or worst case scenario, you didn't send all the money. Guess what? You can always add it to your regular account and start investing and keep growing. But at that time, when you have a long-term gain, you pay a little bit lower tax compared with 22, the next one, 24, 35%. What's the capital gain rate on a long term, 1 year, 1 day and over? 15, yeah. So instead of paying a high rate, they can lower your tax yourself by paying 15 for a long-term investment. 1 year, 1 day will give you 15% taxation only. So moving that money from your retirement account into your individual or living trust, whatever the taxable account, you in fact help yourself lower the taxation yourself. Why not? But in the same time, you don't force yourself at 73, 74, 75, and pay a high tax rate. Because what happened? The rule is, remember 4% earlier, I say at 73, actually you don't pay, you're gonna need to take out more money each year. Why? You age 1 year older, your proposed bills maintain the same, you have to require to pay 6, 7, 8, 9%. So what's the dollar amount going to be? Even larger down the road. So you may even push yourself from 22 to 24 and up to 32% tax bracket. In that case, it's better to do a little bit penny between 60 and 73. Don't you agree? So you can ease out that burden a little bit more and pay less to Uncle Sam and keep more money in your pocket. Yeah. Okay. So as you see, this is all the other exceptions that have right now. Used to be, if you miss something, you have to pay 50% penalty. We all know that. Now they let you, with the Secure Act 2, they let you reduce that penalty to 25. Sometimes you correct it in the right text, in the right form, they may even let you reduce it only 10% instead of paying 50% penalty. So hopefully, none of you in this room have missed any of those RMD refining situation for the last 2 years. Otherwise, you have 3 years of practice. Yeah, 3 years of practice, okay? So correct it. Because just like any other tax return, you think you make a mistake, you can always do a amended return up to 3 years from the day that you file. If ours is that tax. Okay, so let's take a look at the next one. My favorite subject. I heard someone that when I was talking to Francis and some of you are interested in financial account. Anyone know what financial account for? Educated account, okay. You may be ranking. Currently, if you are do up to 18,000 lines, 2024, you don't even have a file, give it after adjustment. If you're giving more than that money away, yes, you just do a pay for it. None of you pay tax. You just tell them I give away more than 20.
对，书里还有的部件看不到，
So
对书只能看到它，
without
那个写的讲不到，就完全听不清楚。
Just do a wholesale night or trade environment, you get away that much money. For 529, you can
没有
one
去需要。
you can put to 5 years, multiple, I think out there.
我只看不到。
1 year and 5 million. The part of objective for that is, of course, you granted or things in the action those who apply. So all the time within the account, they don't have to pay possible. But however, it's a good vehicle to move away some of the assets from some of you that may already passed out on their estate tax, if they think they will have like 13 million this year. But remember, I told you earlier, all the rules to sunset, so that means the estate tax rate will jump quite a bit. And exemption amount, I think will come down from 13 back to about 5 or 6 million only. So you have like multiple rental property or whatever, your asset combined with the 401k account, your IRA account, your other investment account is over that. You need to do a little bit more planning. And for the next 2 years, because when the Trump tax rule sunset, everything go back to the old level. So I think the exemption level back then would be about 6 million per individual. Compared with right now, we have 13 million exemption per individual. So that's over that amount. And happen to be the estate department to the beneficiary, then they will have to pay anything over 13 million that because have to pay 45% tax rate. Okay, that's the state tax. So a little penny for next year is very important. But by moving this money away from your pocket and funding the money to your grandchildren. Of course, why don't I have limited investing vehicle? They only allow you to do mutual fund. But remember, this objective is to save, but not feeding the market and all that. So it's still a good idea to do it. You can move the fund into security account twice a year, just to be one. I'll change it. But however, when you add new funds into the account,
也不好。
Yeah.
from that market condition and pick and choose somebody else within the portfolio.
大概所以他的那个呀，这个都是有没有办法控制的？
对，
不知道，我都是不到。
The only thing about $100 deposit for 3 years.
他讲什么根本不知道。
讲些东西，对于我们来讲都没有用的这些东西。
不过你
不是给 Rosmo 的。
对对。
这个东西是，这个我也知道啊。
This year, say almost 40,000 whatever.
It's good now.
It's too much money. But a couple of weeks ago when he came back and thanked me for okay, he forced me to make instead of $100 to $300. The market over and grow so
看
much
这个还行，他
money.
讲的话我第一句不懂。
没有用。
In the paper college.
看
Now,
英语讲。
almost 60% of my earning is not taxable. The power of compounding is well more important than what the stock market does. In his case, used to be a say, what I'm going to do, I say, you can always take back the money. The money they put in is not taxable. You only have to pay tax on the earning. However, as I say, you know, change the word a little bit, unless you take some money out too. So the security on zero will be beneficiary. The grandkids, let's say, or the kids that go to college and they still have money left over for the 529 account. As long as the account that we open more than 15 years, they can fund that money by taking out from the 529 and add it to the kids' raw. Okay, now the power of the ground, as we all know, when they turn 60 years old, everything inside that account is tax-free. Not like a regular account. Regular account, you have it added to your income and counted as your total income and pay some tax on. Well, I you don't. So I look here, it's the full answer now after college, right? So as long as they work and have $7,000, they don't fund themselves on the Roth. They can just move the money from the 529 into the Roth IRA. They can do it up to the lifetime right now. I think they may change, but they can do it up to $35,000, all tax free in the future. As my two kids, my daughter, I also have my son too. My son is older. He has 7 years of fine. However, if I remember, we always fund the account. Normally, I have the 529 account still for the first year when the IRS allowed me to do it. Yeah, 7 years of fine. My son earned 30% on his account. We spent all. Okay. But 7 years later, my daughter's 529 account to be 20% earning, double. We spend all that too. So the key thing is not what you're trying to time the market. Rather is the savings go in, whatever the earning inside is tax free. But if I said now the new rule is let me move it and start funding their raw IRA also. They don't have to put the money up themselves. But most of my clients want to them say, if a kid has a job and get $10,000, you can help them to fund the raw yourself. But with this, they don't have a way to do more 529 account. But someone will ask me, what happens if kids go to college or they have like Bill Gates, Steve Jobs, Mr. Zuckerberg, they all drop out, right? Second, third year from college, they can take the money, no problem. Let's pay a little tax on the earning. But if they, one of those people, they're already making a very good money. Having been farming for the last 40, 50 years from Microsoft, Facebook, and so on. All right. Any question on that 529 new rules? So again, if you want to move some of the asset away from your, make a space total, that may be a good way to do it. Okay, let's take a look at the next one. Well, I think this is pretty bad deal actually, like, this is some of the rule that, had not been adopted by a lot of employers, but finally the security act to make it even. I mean, for the law item, the sign of 401k used to be they require a minimum contribution, unlike the regular law. Regular law, you know that you can pass it to the next generation without paying tax because it's tax free. There's no R&D, doesn't force you to pay money out every single year when you reach 73. Now they make the same rule for the 401k the law under the 401k. Am I moving a little bit too fast or too slow? Too fast, okay, but like I say, I saved the Q&A session in case of something that come up there. Doesn't able, because not all the situation apply to every single one of you. So you may have some in situation. I'm happy to answer that later on. That's no problem. Okay. Let's see. Some of you like to don't pay your money out of the 401k. I mean, I don't want to pay. You can donate up to 105. Used to be 100,000 into direct to the charity. You don't have to pay tax on the withdrawal. Okay. So if you do that, you don't want to wait for December to do that. You want to do it upfront in the beginning of the year, and you want to have a favorite charity, a favorite place that you may donate. Do it early because they need to do some background work, and you need to notify the custodian to move that away from there into the charitable organization. And of course, those are the private ones, have to be a 501c, that type of organization. Okay, let's go to the next one. Here's a good reminder. Yeah, not sure the test, or there's still collecting paper. Okay, that's all okay for you to catch up to make sure you do all that. As you know, there's no extension this year. Yeah, that's extension for your paperwork always up to October 15th. But the tax bill in the past year is always due on April 15th. So you think that you owe some tax, you want to pay them a $20 bill to avoid the penalty and interest. And then you still have about 6 months later on to gather the paperwork and do your final. So April 15th this year. Luckily we didn't have any storm or whatever. So we have a lot of rain, but not like within the last year. I was wondering, some of the tax over, they have to do a tax. If I look at those, they have 3 pages instead of 2 pages. So we have more work to look at and see if you do it right. So if the program doesn't force you to take a 1040 SR senior, just do the 1040 electrical page. That's 22 pages compared to. Okay. The easy way to do it is take out all your from last year, either you get your tax return yourself, or you have someone do your tax return. You always get those pages. They probably give you everything back anyway. So the easy way is take out those files and take a look at what you received in 2023 or tax year and compare. You have ABCD, ABCD. There's something during the year, there's EFG, so on and so forth. And before you start doing your tax return, you saw. If you do it on by computer, you go one and do it and then this and then come back, those are time consuming. And those is the thing that you make a mistake, you pay the 2 numbers wrong. If you have your CPA or tax return to grant over paperwork, you can also say, oh, I did something near this year. You take a note before you passing those papers, so they make sure they able to have your tax return correctly, pay for this tax. get the most refund from them. You don't want to overpay. As you know, there's a lot of scam around, okay? And as you know, it will never contact you by email unless you are underexamined. And then you have talked to the agent will say, we will send you some notice by email. That is the only time. Otherwise, they always send you a letter. And they will not send, give you a phone call and say, hey, you owe us RS $5,000, you need to pay them and go and buy a gift card, that type of thing. Those, yeah, for sure. Okay, you always get a, okay. You think you own that, the best way to call that one is the number of RS and talk to them. Because normally when you get the letter, don't pay. In my 30-some year doing tax, I think 90% is incorrect, the letter they send out. They either miss something or you miss something. It's always correct. You look at the letter, there's a CP, whatever the number is. Normally, there's a reference number. But then most of the RS letters don't even print your social security number anymore. Okay? All right. So even to get all the one so the entire thing, but some of this they still print the social number. Most they don't. So first of all, you don't look at the front page and don't pay because most of the information is on video page 5 or 6 or 7. Those will give you more detail. What you missed or what they missed or what they think something is incorrect. So read those first. And or if your tax return is prepared by someone, by your CPA, by your tax return, always contact them first because they have your file. They can compare. It's easy for them to catch it. And you notice some names familiar and you think that you haven't given it to your CPA to do it, likely you just make something. So if that's the case, you just pay the differences and file a manual tax return. Or if you look at the letter, you got scan the full and calculate it and know it's correct. You don't even need to file a manual tax return. You can just pay that with the notice. If you know that you missed something already. Okay. Let's take a look at the next line and see what was in there. Oh, wow, we have Q&A already.
Okay.
So let's move on to 4.
All right, thank you, Randy. Before we go into Q&A, the whole set of PowerPoint presentation that Randy went through, we're going to put it out to the members. Okay. All right, now we open the floor up for questions and please raise your hand and I'll come run over to you.
Yeah, I have 2 questions. First one is on education. He defined education.
Undefined education, okay. Currently under the QTP 10, the 529. Anything that use money from K to 12 is up to $10,000. Let's say you're sending the grandkid to a private school. The tuition, that it doesn't matter. For any cost and amount, that is for the tuition, food and supply. Those are able to be used.
And travel.
Rooms and boards, are they in consideration?
Is getting a grant from the 529. So I will refer you to publication 970 on the appendix, page 1 and 2. Again, the publication 970. The appendix, page 1 and 2. If you have an internet, maybe you can go one up later on, then we can go that section. In addition to your question, there's another account called education saving account or something else. I'm not sure people heard of that before. It's totally different from 529. Because that account is not a limit like 18,000 a year. The maximum amount they can put in is 2,000 per year from age 1 to 18 only. After 18, you cannot add money in.
My second question is, can you say a few words about the new charitable account? And how you are able to use it to minimize your income from the IRA?
For the IRA, because you are making a charitable donation, so you cannot get a double dip, so to speak. The reason for that is you don't get to pay tax on that already. So you cannot deduct it from your Schedule A as the itemization or as a donation. But however, if you did not use the money from the IRA or the retirement account and you fund that QCD, then you still can deduct it from your Schedule A on the itemization.
Is there an amount you can deduct from your charitable?
The charitable amount normally deductible if you don't use the IRA, you use your own fund to add it to the charitable account. Normally it's deduct up to 50% of your gross income. Anything more than that will be rolled over to your future year, so you don't lose it.
Thank you.
Let me just add on to one more. For people that will have a donation and donated to the donor account, so what do you call that? Okay.
Yeah, it's a donor advised account.
Donor advisor account.
Yeah.
So, okay, so for example, you donate X amount, but you put it into that donor account, but you have to attribute it to the individual organization account. You can do that, but you can use that lump sum amount to deduct it from your itemization. And later on in the year, you say, this company, I want to give them $100 from the donor fund, and this company, I want to give them 500. You can do it in future years. But the key point is, because you have a lump sum amount, it may help with your donation, it helps you in Schedule A. So you can actually maybe take advantage of the itemization instead of taking a standard account for that year. So you can group all those together. Similar to the Medicare, if you should have to pay the bill, try to pay all the bill in 1 year. Even though the doctor say you can pay the bill January 15th, give them a check at December 31st, so you can bump up your total itemization amount. Similar idea.
Is a question.
Sure.
You do not cover the, gift, your tax-free gift to each individual annually. So right now that's 17,000, right? Correct?
For 2024, it's 18,000.
Okay, so my question is the education 529, if I'm giving to my grandkids, part of that or in addition to that?
No, it's not of it. So yes, so let's say you want 18,000 on the 529, you don't have to file the gift tax form 709. But however, if you put $30,000, you will have to file. Because 18 grand share, rather than 7,000 grand to give them in the check, you do have to file the 709. Yes. So that is correct. Okay.
I think that's the question.
It's the first time I heard about 529. My question is, do I do that with my accountant or do I talk back to my financial advisor? I do it myself in the whole document.
Can be opened by any brokerage firm, or you can use a financial advisor to help you open. Okay, they're very simple. The funding on that is to give them a check, and you're thinking and purchase inside that is a mutual fund. You cannot buy individual stock. Within the account, after select the individual mutual fund, or you can pick two or based on age, or based on the how aggressive the market is. So you can select 2 or 3 different ones. Within that, you can change twice a year, move one fund to the other. That's it. But however, let's say you only put 10,000, you have another 8,000, or your spouse have another 80,000 to put up. That additional amount can be moved up. Sometimes it's 3,000. Or how should I say, move within the fund.
Second question.
Follow-up question?
I have a second question. You talk about give this year's 18,000 a year. I give to someone as a gift. Does he has to pay an gift tax? Does he have to pay tax when he receive this 18,000?
The person who give out the money doesn't pay tax. The person who receiving it doesn't pay tax. Even when you have to pay some tax, or I call it state tax, if the person is giving out the money when the lifetime is expected all out more than 13 million right now, then you have to pay tax. That balance over 13 million, currently is 45% tax. So nobody pay any tax at all until reach that higher amount.
So if I understand correctly, I gave 80,000 to another person, I don't take. Do I get tax deductible?
No, that's, sorry.
I think that I have to pay the tax.
There's no tax paying involved in between the donor and the donee. The one who receive the money, the one who give out the money have no tax involved. Until the person who give out the money, reaching that 13 million in that magic number, between after so many years.
Little question.
Okay.
Question. 401k, when you took out, when you put it in, for like me, you didn't pay tax. But when it came out in public years, that's equivalent to 401k. When I took it out, I put in account. Every time I took it out from the bank account, my advisor told me I have to pay 20% tax to the federal government and 50% to the state of California. So my money will pay 35%. You said you can, I didn't quite catch the word. You can take a little bit and try to avoid that. Once you suggest avoid, I have to pay 35% tax.
Okay, let me repeat the question. So let me do I. The bank or the institution tell you, when you take the money out from your 401k, they need to withhold 20%. And also withhold 5% whatever for California. True or not true? Now, what your intention is, if you're taking the money and keep it for yourself, they normally help you to pay some tax. So at the time when you prepare your tax return, you don't have a big check to write up for salary or state of California franchise tax code. However, the second scenario is you are not really taking the money. You are moving the money from bank A to bank B or mortgage A to mortgage B. You call that a rollover. Normally, we don't advise you to do it yourself. You ask the receiving institution to send them and say, I want to move this money. So when they do that, they normally have give you a 1099 with code G on the box number 7, telling you that you are rolling over, so you don't get the taxation. If you do that, Bank A or mortgage A will not require to withhold that 20 or 5% or whatever percentage, because it's a roll. They will move the entire amount to your fee.
My advice already to get rollover, no tax. But my tax financial advisor told me every time he did roll already, he had to take the money out of that.
When you take money out later on, yes, you want to pay some tax upfront to withhold to avoid a big lump sum payment when you doing out your tax return for that year. That is a regular withdrawal. That is not a rollover anymore. So after you really spending your money, yeah, you want to take some tax out. Some people are even advised them to take 35% because we did the tax return last year. We know that or they already at 35%. So instead of missing another 15% and then doing the tax return next year, they have another 15 to pay. They can check the right from themselves. Remember, it's another rule. And just want to get your money at the end of April 15. They want to get like you have a paycheck, W2. Okay. So the rule is, if you have a payment more than $1,000 on April 15, they start charging like 20% tax. Or under your basic tax. So you account 2%. Yeah. And
There's another.
it's one of the avoidance. The reason for that, you want to pay as you go. Just like when you're receiving a W2.
Randy, here's another question.
Sure.
I missed part of your seminar in the beginning, and to talk about, the you give 529 college savings,
On the 529,
college savings.
college saving is 529. Have a different name, that's all.
Okay, the donor, how much can you give? And is it, deductible?
It's not deductible, number one.
No deductible.
It's not deductible from the government, okay? Number two, your question is, how much you can give out? You can give out 18,000 per year per individual without buying the tax form. But you can upfront it 5 years. So 18,000 times 5. But then you have to refile it with tax form. But nobody pays that.
Okay, you talked about earlier, the education plan. Whatever's left, when they finish education, they could roll over into an IRA.
And also,
Yeah.
more specific, law is don't pay tax in the future.
Okay, pay,
Up to $7,000, you can apply later, you can review it again. It's $7,000 per year for the next 5 years. Providing that young adult make that much wages for income, not unearned, has to be earned income.
so this is not their earned income.
It has to
They
be
would
the
have to
earned
pay
income.
tax when they take it out.
Yeah, it has to be the earned income, but they don't have to use their own money to fund it.
Okay,
They can move that money from 529 to fund that raw item.
okay. But eventually, when they take it out, they're gonna pay tax. No, no. Oh, yeah, oh, they don't.
That's what we want to do, right? So they don't have to pay that.
I'm here and then you're all back. The gentleman.
I have a question about using the global tax, you know, so just about the board, they asked a question, they asked me to fill in. So it's still, the user have to be aware of when using the global tax. You have talking about all this detail that I'm not familiar with. I said, what did I miss anything?
Okay, let me answer how TurboTax works. TurboTax normally have two amazing. So you, unless you know your, can you come in front of the mic? Okay, thank you. Unless you know your tax really well. Otherwise, when you're using TurboTax to do a Q&A, you may not read the question correctly and you may answer incorrectly. Or more, in that case, you may want to really hire a professional to answer some of those questions in order for you to fill in the form correctly. Because most of the tax preparers, they don't even use Q&A. They use the actual form to do the return for you as the client. So they, after they finish it, they review it and see any other advantage thing that they can do and call you back and say, hey, Mr. Mrs., you can do all this and you're able to minimize the tax. That is the way it's supposed to do. So I have few people call me every single year and say, I'm using my TurboTax. They reach me that question. Then when I ask the question, they just misread it or they just don't know how to answer. So when you don't know how to answer it, likely you get the wrong information or your tax form is wrong incorrectly. Okay, go ahead.
Excuse me, I have a question. For section 4, loss account or income.
On the 401k and 403b, as long as you work, you can continue to contribute, yes.
Okay, thank you.
Up to the level limit that your parents allow, and if you're over 50 years old, you can put the additional cash on, yes.
More questions? One over here. And then.
I have a question. I was confused about employee, 401k plans. As an active employee still, that money under our rules is protected from RMD. This is not an unusual thing, but we have. So, when I take money out of the 401k for living expenses, I can also use some of that money to go into the education plan and reduce my taxes there. But the other part that I'm taking is a check from the, our 401k. Has to be taxed, 20% withholding and 10% withholding for state. That's correct. And then has that changed at all?
Let me take your question in two steps. Number one, any money coming out from the retirement plan is taxable after, when you're over 60 years old, just pay the regular tax. The 20%, 5%, whatever percentage is also based on each individual. You can change the percentage. Tax the custodian say, I'm gonna put 40% for one per whole 11.3% or 13.3% on California, because that one's top rate. But you can also lower it, but you will run into the annual later on. If you finish your tax return, you don't pay enough to yourself upfront. You pay $1,000 bill, you just ending up paying a little bit more interest or underpayment penalty. So the second part of the question, after you take all the money, what you can do, that is a separate issue, because step two now. That money, you can give it to the grandkids as education, if you want your question.
Yeah.
Okay, yeah, that money after the tax, you finish your tax return, you have paid them enough, and finish your tax, whatever left over, you want to give it the grandkids as the education savings. That is a separate thing, because it's the step number two. If you give more than 18,000 upfront for the first 5 years, they never have 529, you need to bill on 79, that's all. You don't get that. If you get the money, they pay the 529, they pay tax, no tax involved. Until you give them 13.3 million, 13 million, yes, we have that problem. Okay.
Next question.
Yeah, the question of the partial state tax divided like Maryland for 8%, and then like California for 4 years. My income supposed to pay tax to which state?
Very easy, okay? Those, I advise you, don't do your taxes out. First of all, you compute your 1040, what your tax preparer will do, and they'll ask you what part of the income comes from what state. When you do that, all the forms, they have to go to the part year. So each state you will find part year resident. On that, you will have allocate the correct amount for each state. For California, if you have to pay back from the other state, you can get credit, and the form is called Schedule F. You can get a special credit if you have to pay, what other state? Maryland, okay, so in that case, you pay tax, X amount to Maryland, and the Schedule F will help you to get those tax that you pay in California as a credit. And the form itself for California will ask you exactly what day you move from what state, what day you enter, for how long you stay here, in how many days. And they will automatically prorate it and calculate it correctly on your 540 NR form. So this year, if you do come from another state, I want you to do your tax return yourself. You will be spending more hours than you may want to go and enjoy yourself out there with all this tax rate in California. So, and by the time you finish, you will not even know that your tax was completely correct.
So what I have undertaken. So on the with all my in all tax.
Yeah, correct. And then why they divide up the things that you have in each state, then they will pay tax accordingly for the state. First is the same, no change. First, no change.
Like we are the total iniquity as on 8 by 12 to be like not exactly. And then
Not exactly, because the mainland tax law also, I mean, number of days of the stay here. And then automatically from your 1040 return would flow it out into your state return record. So you don't do it by hand. There's no way. As a professional, I'm doing tax return for 30 years. We put in all the correct information and let it company first. And then we go back and verify those numbers and see that's correct. No way they can do that hand. I think my first return 40 years ago, yeah. But anytime you make a mistake, you go back to the worksheet and start all over. It doesn't work there anymore.
Okay, any more questions? We have a lot of questions on this side, high volume, this side. No, I do have a question. So, a lot of us coming from Asia or, being immigrants from Asia, and we still have a lot of connections or, friends, family in Asia where we have financial dealings. I.e., you might have a financial investment, you might have bank accounts, you might still have, a building or a house somewhere in Asia. How do we deal with this? Can you briefly give us a rundown?
Sure.
What should be done?
You keep the hands everywhere. Remember, the US taxation, you are taxed worldwide income. That means no matter where your money is sitting and producing some income for you, you have to pay tax on yourself. Doesn't matter what your status is, if the green card holder is US citizen or whatever. That's only very simple. If I always ask, do you have any bank account or investment account out in the United States? If you say yes, and the next question I could have, in any of those 365 days, you combine all the account value is over to $10,000 US. If you say yes, I say congratulations. Guess what? Here's the website. There's the PDF. We just do it and submit it to the FIN. Then, what is insurance department? Nobody knows how it's. That's the tax money. Okay? But however, if your amount is over 50,000 or 75,000, depending on married or whatever, then say, congratulations. When they finish that, showing out that Bible report, very simple, probably what? What's the account number? And in your bank address, how much you get out of those 365 days, the highest amount. You should make up the number. You don't need to match the statement. That's no kind of fulfilling the correctly. But however, you have 5 accounts, you have list every single account. Okay, so back to what's the report that you need to do. However, remember I talked about 50,000 75. Guess what? You have to give that report to your tax preparer because they need to go another form from 89. 36, I think, if I told it correctly. Because that will be required to add to your tax return as the original. However, you stay at the house in Hong Kong, China, whatever, that's not important. If you do receive that income, let's say rental income, you have to tell your tax preparer and say, I do get rental income from that property. They just do another schedule C or I.E. Rental is a schedule E, ABCDE, and that tax return can attach to it. So that's no difference on the reporting. Some of you may even get pension from Hong Kong, if you work there, or Singapore, or whatever, or any other place in China. They give out retirement income at 55, I think. So those income, even though it get deposited into your bank in China, under 10,000 US dollar, you may not have to report on that. You still have to report on your 1040 as income. If someone inherits something, guess what? You can transfer the money in. That's not a tax line to fill out. That's the amount is 10,000 US dollars. That's what you have to go a phone call to the front to tell the secretary. I got some money from overseas. But I do not make money out of it because I didn't work there. I just inherit the social money. Once you file that form, you don't have to pay tax either. However, when the money arrives in the United States, start producing some income for you, earning some interest for you, you get a form of your bank and you apply for the interest and dividend.
Okay, thank you. Any more questions?
Question.
One last question.
General advice. Hypothetically, somebody has a pretty good sized IRA to convert or not convert to Roth. That is the question. In what kind of situation should the person convert? And should, and in what situation they should keep it as a traditional item?
Okay, that's number one. You have science a lot. Your question is, convert it into what? Remember, the step number one is when you convert it, whatever the amount you like to convert, you add it to the income for that year. So the trick is not to over yourself by 12% to 22% or 39% or 37%, to bump to sell your next tax bracket first. Number two question we should ask is my non-legal been used for lifetime? If the traditional IRA account in general will use it in the lifetime, convert it. At age 60, 70, 80 already, you're paying the minimum tax 15-20%. Why you want to upfront? Because when you pay that, you also need to pay to California, so to speak. And also, how many years you will earn that? That's 15 or 20%. So let's say I put in a very conservative CD. It paid me a good 4.5%, 5% now. Guess what? You may have about 5 years to break even, right? If you don't break even, then maybe you just pay uncle Sam early. So I rather you don't.
The higher income bracket you are, so the least likely you advise not
Yes,
to convert.
that's correct.
32% income tax was no point, right?
Yeah, no one. Just think about the minute you spend or hit the RMD, or as better yet, early in the conversation here is what they can start at 60. Why wait until 73? Your ball is growing so big after 30 years, your portfolio will live. But that much, but you have to take 4%. If you're husband and wife, that's what you both have higher, both your work for your lifetime. Why you want to pay Uncle Sam more? Get those money, take a good trip, take another good trip, so we all put it down.
I guess it's about time to go enjoy ourselves. Let's give Randy a big hand and thank you for coming. And see you all in April 8th. April 8th.
Oh, yeah, my disclosures, my lovely disclosures.
Those. We don't spend any project with all the key numbers we talk about. 2024 year, we can think of those numbers and start changing the stuff.
Folks, before everybody. Yes.